Hey everybody, Brent here with First International Bank and Trust. Wanted to talk today a little bit about what goes into a monthly mortgage payment. So that would be more than just the principal and interest, like on a student loan or a car loan or any other closed-ended loan. There's a few more components to that, and the term I want you to remember is PITI, and that stands for principal, interest, taxes, and insurance. So there's four different pieces of that monthly payment. A lot of times when you're looking on websites, you might see the estimated payment and it might not include all of those things. So very important to have that included in your budget when you're looking at purchasing a home or even refinancing. You want to make sure you've got those all accounted for. There's also things like utilities and other expenses with owning a home, but this is just on your monthly payment itself. So the principal and interest, that's pretty self-explanatory. Most mortgages are set up on a 30-year term. So 360 months, and that will include an amortized payment, which would include like your principal and your interest. So that part's pretty straightforward. Obviously, the lower the interest rate, the lower that portion of your payment would be for an identical loan. So the next part of it is what is called your taxes. So that would be your real estate taxes. So PITI, principal, interest, taxes, which would be the county taxes that are assessed on the particular home that you're looking at. So that is one thing that you do want to look at when you're looking at homes. Take a look at the property taxes. You may find that two homes in the same neighborhood at the same price point may have vastly different property tax amounts. So you're going to want to look at that. The easiest way to calculate that into your payment is take the full annual amount, divide that by 12, and then that's what gets included into your monthly mortgage payment. The last thing on there would be insurance, and this can be actually a couple of different types of insurance, or actually three different types. That would be things like your homeowner's insurance or your hazard insurance for if something happens to the home, if it burns down. There's a premium associated with that to cover the home and make sure that you're insured. There's also things like flood insurance. If you happen to be in a floodplain, you are required to have that if you have a mortgage. If you're not in a floodplain, it is optional for you, so you would want to look into that as well. And then the last one is what's called mortgage insurance or private mortgage insurance, or PMI for short. And that is typically required if you do not have a 20% down payment on a conventional loan. You do have to pay what's called PMI insurance, either with your mortgage payments monthly or pay a premium up front. So all of those items are included in your overall total mortgage payment. And whether you pay them in with a monthly payment or you pay them separately, they are all expenses and part of that mortgage. So if you've got questions on that, if you'd like to get nailed down where your monthly mortgage payment would fall, or maybe you've got some questions on if you would need flood insurance or PMI or whatnot, I'm going to put a link here in the post. You could click on that and yeah, just reach out, let us know if we can help with that or if you need any additional clarification. So big takeaway would be there's more to a mortgage payment than just the principal and interest. There's the taxes, insurance, and flood insurance, PMI insurance, all of that. One other side note, if you are in a property that has an HOA, that is not included with your actual monthly payment, but that's something you want to account for with your budget as well. So hopefully you found that helpful. If you've got questions, feel free to reach out, share this with anyone else that might be looking at purchasing their first home, and we will talk to you again soon. Thanks.